All right. Hi, and welcome everybody to the Retirement Income Planning webinar that we have set aside for you today. Looks like there's a number of people that are already excited online. There's a number of people getting ready to learn today. And so we're extremely excited for our Retirement Income Planning webinar that we're doing today. I do have an incredible financial advisor guru when it comes to a lot of the stuff when it comes to understanding finances and financial plans. And that is Mike Webb. So hi, Mike, and how are you doing?
Good afternoon. How are we doing today, Nathan?
Wonderful, wonderful. For those of you that do not know Mike and know his background, Mike is a chartered life underwriter and a chartered financial consultant who has been who began his insurance career with his father. And together they established Webb Insurance. In 1992, Mike became an agent and a member of the Society for Finance Professionals. And in 2008, he entered into a partnership with Jerry Grossman, which resulted in St. Charles Financial Services. Mike also has a vast knowledge in underwriting of property and casualty insurance. In his desire to meet his clients' many insurance and financial needs, he developed a multifaceted agency which offers a wide variety of products and services. Mike graduated from the University of Missouri-Columbia, and he's also a member of the General Agency Management Association. Mike lives in St. Charles with his wife and his daughter. Hey, Mike, we are super excited to do this retirement income planning webinar, aren't we?
Absolutely. There's a reason the chessboard's showing right there. We'll talk about that in a minute.
Yeah, Mike is talking about this chessboard right here, guys. For those of you that are wondering, we are going to talk about retirement income planning, and we're going to do it from the concept of being strategic. What strategic moves do we need to make? How can we utilize different tools and resources within our financial plan to help us through retirement income planning? And if you're just tuning in, we want to say welcome and thank you. Throughout this entire presentation, there is a comments, whether you're catching this on YouTube or you're catching this on our Twitter channel, or maybe you're just catching this on the overall webinar or on the replay. Feel free at any time to put a question in the comments. I will be monitoring those comments. And towards the end of this presentation today, we'll be able to make sure that we get all of your comments and questions answered. With that said, I'm going to go ahead and back up here, Mike, and turn it over to you so that you can walk us through retirement income planning and how do we maneuver our retirement plan like a strategic chess move.
Absolutely. Thank you, Nathan. So, if any of you have played chess or thought about chess or read about chess, it's all about strategy. And, you think about it. I did play actually for multiple years when I was in high school. And one of the masters that I actually learned from, he said it very simply. For every move, you have to think 3, 4, or 5 moves in advance. So that is the concept that I carry with me and have carried with me for a long period of time. And we have to apply this and how this works within the world of finance. And St. Charles Financial Services and our team here are here to help you with working through those strategies. So at the very beginning, you know who we are. I do want to go to the next screen that talks about our disclaimer. I'll give you a minute to just kind of read through that, what we are and what we are not. We're here to help you to learn what's going on in the economy, how that applies to your financial plan and or segments of your financial plan, and talk specifically today in great detail about Social Security, how we want to utilize Social Security, how other things integrate with that, right? Because that's going to be very, very important. Going back to the chess theme, it's kind of like the opening move. Sometimes people, what pawn do I push forward? How do I back that up? And you start creating the gamuts of the game. If anybody who's a student of chess, there's gamuts that you can learn. And as you get better and better at chess, those gamuts become more and more important because you start to recognize those things. Well, financial planning is no different. Okay. So in today's topics, we're going to end up talking about the general information of Social Security. Okay, so we're not going to necessarily get into the disability side, Social Security disability. That's another question that if something came up and you individually wanted to talk about that, That's where we would schedule a meeting, how, something going on in your life or a family member's life, and what does that mean to you? It's going to be more just about retirement planning, right? So how does Social Security actually, how is it going to apply to you? Well, the first thing we need to know is, Social Security, you're eligible at age 62 in order to start drawing at the early age. Age 70 is the oldest. And then there's a thing in between called the full retirement age, FRA. So we'll cover that a little bit more. When you start thinking about the importance of coordinating all facets of the retirement income strategy on point 3, it's vastly important to think about not only today, but the near term, midterm, and long term. Okay, because there are things midterm to long term we just don't know, right? It's because the laws change. That's the reason why when you're working with an advisor, such as, if you're working with us in St. Charles Financial Services, we do have reviews for our clients, and they're typically at an annual, a 6-month, a quarterly, or even as frequent as a monthly basis. Because as the rules change, therefore the game changes, you need to be on top of that, and we want you to be. So with that, we start talking about, key pieces in the chess game, right? Well, we are equating, the king here to Social Security. I mean, for the majority of families in the United States, Social Security is a big piece of their income. When we start thinking about how it impacts people, how you draw it, if you are married or if you're single, if you have been divorced, so on and so forth, there are various options and decisions that have to be made. And then when you look over to the far right there, you see the knight, right? So we want the white knight to really think about those retirement savings and accounts and things that you have that you've done on your own, and how does that apply? And on the bottom, you see the rook with the employer-sponsored plans. We're going to talk about that just a little bit more. When we think about employer-sponsored plans, okay, what do we talk about? The 401ks and the 403bs. And, we think about the defined benefit plans, right? Pension plans that you can have access to. I'm going to talk about that a little bit more in here in just a second. So I want to talk about this nice screen here for a second. You see Uncle Sam standing there next to a business person, and you see he's sweating a little bit, right? So this is the 900-ton gorilla in the room. When will Social Security be there for us in the future? Will it not? We always get this question when we sit down with people. Social Security is one of those things where, is it going to be there for a child? You just don't know. But at this period of time, let's talk about the history of Social Security. When we go back into the 30s, it was actually a fully funded program. We wanted to be able to take care of everybody. Well, when we think about where we're at today, those people that are all drawing Social Security are actually being supported by those working today. Kind of a pay-as-you-go type of situation right now, right? Well, when you take a look at that, Uncle Sam is sweating there for a reason, because guess who's next to him? They're talking about Bernie Madoff, right? This man's going down. Why? Because that's what he was doing. He was taking money in and getting in from clients, new clients, and then turning around and giving that to old clients. That's not a recipe for success. So when we start thinking about what that future looks like, we have to keep in mind that a lot of people are paying in for those that are being supported right now. So when talking about that, we look at where we're at today, right? I'll let you read through that piece real quick. The trust funds are projected to become depleted around 2034. If you end up looking a year earlier, okay, that's 1 year earlier than what we projected in the previous year. So that's 78% of the benefits at the time. That doesn't mean it's going away. That means that we have to find other ways that we can help to fund this, and hopefully our leaders do the right thing in the way that they work with that. So with this real quick, I want to talk about something that we use a lot when we sit down with clients. It's called the personal economic cash flow model. And you'll see a lot of tanks and pipes there basically, but it's really designed for a reason. When we look at the lifetime capital potential tank on the far left, so that's earnings and all of those things that you're going to be able to get while you're working, right? But if we get rid of that and we say, okay, down here at the bottom, Social Security is a main stream of income. You have your assets and things that you saved in the safe tank and the risk tank. And then we have the house over here, and maybe you have a liability, a home loan, maybe you don't, right? That's just whether you have one or not. This is a pretty common picture for a lot of families. Now, you might be asking in the safe and the risk tank, okay, what's the red? Okay, well, the red is actually taxation. So we have to be mindful that, when it comes down to any kind of planning, we have to take tax into consideration. There have been periods of time throughout history, believe it or not, that the highest tax bracket over the past 100 years has been 91%. Wow, that's a big number, right? But we also go back to the early 90s, okay, and the highest bracket then was 28%, but it started at only $32,000 of adjusted gross income, right? So, we have to be mindful of how the government can change the rules on your planning, integrate that with Social Security, and ultimately that helps us along the way to do the right thing and move forward and make sure that you're as secure as you can be overall. I kind of equate it to, if you're familiar with chess, and there's a move in chess called castling. Okay, it's a move that you can make between the rook and the king in order to protect your main pieces right there, right? So in the event that you're put in a corner, you could do that. And actually, it's a very strategic move. Well, you know what? That can be something that we have to think about in looking at your investments and how Social Security is working, along with, whether it's a 401k plan or whether it's investments that you put in a brokerage account, right? Then, we can strategically work those year after year. And where we start out today, if you're starting to work with us, it's going to probably be completely different in 5 and 10 years. Hopefully, quite a bit the same. But the laws are going to dictate what we have to do in working with you in order to do what? We want to make sure that you keep what you have, you continue to see your portfolio grow, and we do that on hopefully a less risk-adjusted basis, which would be the ideal situation. So, a lot of people, when they look at the age of 62, which is the earliest that you can take Social Security, there's a lot of people going, wow, with all this stuff that's happening out there in the world today, what should I do? Do I take it now? And there's some reasons why you should and some reasons why you shouldn't. An easy one to talk about is if there's a health issue, maybe we take it earlier, right? That might be something that we have to take into consideration. But you also have to be aware that if you take it early, okay, prior to your full retirement age, for many of you, that's going to be 66 in so many months. For myself, for example, it's age 67. If I start taking it early and I'm still earning an income, there's a little thing out there that can happen called a penalty. We'll talk a little bit more about that here in a minute. So part of this is, okay, how do we maximize those higher Social Security benefits, specifically with longevity, right? A lot of people are living to 85 to 90, and we need to really think about that. So what can the government do? Okay, the government can push the retirement age out for younger people. Is it entirely possible that maybe for people that are 45 to 50 and younger, that full retirement age is no longer age 66 in so many months or age 67, but it's actually now age 70? Well, how much money can the Treasury actually bury and have on the balance sheet if it's that 3 years? I mean, think about if somebody was eligible for $35,000 a year over 3 years, that's $105,000. That's pretty significant. Of course, we can increase taxes on those that are working. We can also work within the consumer price index. So for a basket of goods, right, how much are we paying? We have to think about that. We can also adjust the earnings restrictions. So, there's actually a cap on how much of your earnings is actually taxed. Okay, when you start looking at the FICA tax and supporting that, or some combination of the above. What I do want to talk about for just a segue real quick, I'm just going to leave it right here. And I'll push it forward one. We have to know the rules, but I want to talk about a real life situation. To where we've had situations in the past where a husband and wife, for example, maybe age 65 and 63, let's say, looking to retire, they do retire, and we start talking about Social Security and maximizing that, that benefit. And then, we do all the right things. Okay. So let's say it's May of the year and he's age 65. And then he has a traumatic health event later on in the year. So, in the event that we have that health event, whether it could be a heart attack or a stroke, it could be a debilitating situation. We have to be ready to pivot and say, okay, well, now in this case, if and we look at this, maybe there's a possibility he can get Social Security disability, and then how does that work with his other plans that he has? We also have to think about how do we maximize his wife's Social Security. It's actually interesting. The past few years, as a lot of women are becoming the main breadwinners in the family now, and it's thinking about that combined. Maybe there's two incomes that are, if it's $200,000 a year of adjusted gross income in the household, and it's $100,000 apiece. That's a big deal, because if you lose one person or a big chunk of that income, that's 50%. That's a really big deal. So I just wanted to segue away from that for just a second. So the key is knowing the rules, right? So how do we optimize the benefits? Okay, when we start taking a look at how this works. So, if you look at the far left, it gives you the year of your birth. And when we look at the full retirement age, anywhere from 66 to 67, as you can see. And then if you look at the third column from the left, the months between age 62 and full retirement age. So in the event at the age of 62, you'll see that in the gray bar, kind of 2/3 of the way up the page, or let's say a third of the way down the page. We're assuming at age 62 that we take that. What is the reduction for $1,000 of Social Security benefit in the event that you take it early? So as you can see, the reduction of benefits, 25 to 30%, is actually pretty significant. But take a look at that far right column, a $500 monthly spousal benefit, and what it can be reduced by as well. We have to remember that any move that we make early can affect us later, and not just us, okay, if I'm saying myself personally, but also my wife. That is a huge event. So what can you do? Okay, one of the things that we can talk about is potentially delaying those credits, right? So if we look, at the year that you're born, and it shows 1933 to 34 and up to 1943 and later, I'll tell you, for most folks that are listening on this and the people that we talk to, whenever you look at deferring it from full retirement age, let's say that you're at 66 and 8 months, or full retirement age is age 67. When you look at age 70, okay, it's about 7.5% to 8% is the adjustment that you're going to have on your forecasted Social Security benefit. So if we started at $1,000 a month, for example, at age 67, that could be as much as $1,300 and change at age 70. So, I would say that that's a pretty important part that we have to really factor into the equation, right? So if it ends up being that a person is fine and dandy at age 65 and they're healthy, but then they do have a health event, we have to take that into consideration again, like I mentioned a moment ago. So longevity. So, we think about this. What has been happening recently outside of the pandemic period of time has been that people have been living longer. Medicine, it will get better. The technology will get better right alongside with medicine. And so there's going to be more longevity for people. So that statistic right there, if a man and woman are married, the chance that at least one of them will live to any given age is increased. There is a 50% chance that one of them will live to age 92. If anybody's into statistics, that's a pretty big number, okay? And when we think about that longevity piece, I can tell you, we have a lot of clients right now with family members that are, 92 to 95. We have had those that have reached the high 90s. So it isn't necessarily just 85 and 90, but I will tell you, quite interestingly enough, another real life story. There's been multiple clients that have come into our office and we talked to online over the phone, and they say, well, I'm age 65, age 67 right now. The longevity in my family isn't good. So maybe there's a lot of folks in the family that maybe didn't live past age 75 or something. But I tell you, what we have to do is plan however you as the client are directing us to plan. But you need to know, hey, you're hiring a professional here to push back a little bit to say, look, there is that possibility, and we have to account for it. So it's something that we need to think about. So in just getting started, okay, it looks like the screen popped back up. That's good. So what can we do, right? So you can file early, you can file late, you can file at your full retirement age. This is something that some people do not know. You can actually file on your spouse's record. If there's a divorce that has happened, right, and you were married 10 years or longer, but it's been 15 years since the divorce, we have to check when we start looking at Social Security benefits. Are yours better? Is there a X that is better than yours? A combination of those things. So when we end up taking a look at those scenarios, we want to take a look and make sure that we are doing the best that we can for you to maximize that. That is a cornerstone of what we talk about in our firm. You're going to hear the term luck, L-U-C-K, liquidity, use, and control over your money. But we want to do that on a knowledgeable and strategic basis. Okay, the access to capital is enormous. Just like an income stream is enormous. We have to look at the income, we have to look at the assets, and we have to say, what's the best way to handle this? And usually Social Security is a fairly large piece in that. So if somebody ends up taking Social Security early, okay, we have to think about this. All right. If it's, let's say you're age 62 and you're taking it, but you're working still, $1 of benefits is deducted from your Social Security benefit for every $2 of earnings over $19,560. So if we end up looking at that in simple terms, we'll go through a case in a little bit, but that can be pretty significant. In your full retirement age year, okay, $1 of benefits is deducted from your Social Security benefit for every $3 of earnings. So $51,960 as compared to $19,560. The third bullet point down at the bottom, however, a lot of you might be surprised by this. Once you have reached full retirement age, you will receive your full benefit payment regardless of how much you make, regardless of how much your modified adjusted gross income shows. You will not have to worry about that. Now, what we're going to learn about in a minute is that there is taxation potentially on that. So, what is modified adjusted gross income? Okay. Modified adjusted gross income, this is just a quick calculation that you can utilize. I am going to go back and make a statement for any of you that are interested. We have a packet that we normally send out to people. If you are interested in an online meeting or an in-person meeting, this packet that we provide has a lot of information in it. And knowing that it came specifically from this event, we can include this page in there so that we can talk about those calculations. So modified adjusted gross income actually includes many things. On the letter D down below at the bottom, you'll notice it says any interest of tax-exempt interest income, such as interest on municipal bonds, is actually pulled into this equation when they look at this formula. That's pretty interesting because a lot of people are I have a Missouri municipal bond, right? And I don't have to worry about tax at the federal level or the state level, but you have to remember it does impact this formula when we start talking about Social Security benefits. So here's something that's pretty eye-opening, right? So if you're married, okay, and you make over $44,000 a year when you're retired, now there's a formula, but that Social Security benefit is taxed up to 85%. So 15% is tax-free, but 85% of it would be taxable. Okay, so in the event that it's between $32,000 and $44,000, all right, 50%. If you're under the $32,000, okay, there's basically no tax. Now, I'm going to, when you look at the single, it's somewhat similar, but a little bit lower. But we have to take this into context with the state that you're in as well. And I'm just going to use Missouri as an example. From the state tax level, and this is something that you can talk to your accountant about or look it up on your own. The government's website for Social Security is actually very, very good. We have to be mindful of, when you do that research, go to those sites. If it says .gov, that's real. But if you Google something and there's 10 pages of stuff, right? Some of that's just, it's going to be opinion. Some of it's going to be marketing, that kind of a thing. So you want to get the real scoop. That's where in talking to somebody like us, that really matters. So we want to be able to work through that to where we can look and say, okay, what are your top priorities in your financial planning? So usually the way we talk about this, or there's a level of priorities: level 1, level 2, level 3, the number 4, number 5, right? Number 1 is typically, what are your goals and needs? Number 2 is what? It's, a lot of people would say, well, it's investment, my investment portfolio, and how much money I'm going to make. It could be something else. Well, let me clearly say this to you, that our firm believes that number 1 needs to be your needs and goals. That's what you want to happen, and that's going to be the ground rules for us working together. But number 2 is actually probably going to be more focused on taxation, because I could do a wonderful job in managing your portfolio. But let's say that 401k rollover, we grew it from 300,000 to 600,000, and it's 10 years later, and the government changes the rules of the game on us, to where we look back and then we go, wow, you're making more money now. We've done a good job. We're taking some money off of your portfolios, along with Social Security and maybe a pension and that kind of a thing. We have to be very mindful of taxation. I think that's very important, because at the end of the day, when you take a look at your investments and the returns that you make, okay, it could be that if we ended up getting you a 8, 9, 10% rate of return, hypothetically, and again, that's hypothetically, what happens is if you had an increase of 20% in your tax bracket, it could have eliminated all that and more. So, we'll talk about that quite a bit when we get into individual meetings with you, if anybody is interested. There is a sheet out there, the fact sheet for Social Security. It's something else that, we were happy to provide. It's actually, you can jot that down or copy and paste that down. The SSA.gov, to where you can pull this up, and it gives you the basic information about how Social Security is currently being, the fund is continuing to be in the black as much as possible. It talks about the FICA, the various things that they have to collect. Now, like I had mentioned, there is a cap on that, and last year it was around about $160,000 a year. Up and beyond that, those taxes were not collected. Now, there's things that are going on today, if you listen to the politicians and what people are talking about, that, hey, maybe we do need to tax up and beyond that. Just a whole lot of stuff that's out there that we're going to have to pay attention to. And that's our job in working with you as our client, in order to look at what you're doing and say, hey, you know what, we need to adjust things based upon this law that just passed. Normally we catch that very early, like during the pandemic. There were a couple of stimulus packages, relief packages that were passed, actually trillions of dollars. And you know what? There were some things buried in that impacted people. One of those things that had changed during that window of time was, when do you take your required minimum distribution off of your IRA or retirement account? Well, we know in 2023 that age has actually gone up again. It's age 73 now. So there are some things that we can dive a little bit deeper into, and how does that specifically apply to you and your planning situation then. In optimizing your benefits, we want to take a look at a case study and just use this as an example, pretty easy example of how we can help people, just specifically on the Social Security piece. But then we're going to talk a little bit more about the portfolio. So in this example, John and Jane, age 62 and 61, John's Social Security benefit at full retirement age is $2,520 per month at age 66 and 10 months. Jane's, hers is $1,185 at age 67. Both assumed that they would begin benefits at the full retirement age. Okay, so what we have to take into consideration are some other facts, right? John has $850,000 in his 401k, and they have $350,000 in a joint account. All of their money was invested in a traditional balanced approach, 60% stocks, 40% bonds. For many of you that have been paying attention, another segue to the markets and what's gone on over the past couple of years, 2022. The year 2022 was not a very friendly year for that balanced portfolio, 60% stocks and 40% bonds. We had the markets to where equities dropped, as did the bonds. I'm going to jump back in here. John and Jane would like $6,000 a month after tax to support their retirement lifestyle. Okay. So when we start looking at optimizing benefits, we need one more piece of information, which is actually one of the most important pieces of information, is what's our longevity, like we talked about a few screens ago, right? In the event that somebody believes that they're going to live a shorter life, we're going to take that into consideration, but we're also going to caution you. So if John figured in this case that he would probably live to age 85, but he said maybe age 80, we're going to talk through that. But everything that we're showing you, we're going to have a conservative scenario to where it shows that you're living longer. Jane would be assumed to age 90. That's a pretty common thing, right, for women. Right now I know we have multiple ladies that are in between the ages of 90 to 95 that we work with. Blessings to them. They're doing well. So in this example, based upon what John and Jane wanted to do, you'll notice in the software that we use that there was a 57% success probability of them making it. What does that mean? Well, there's a 43% chance potentially of not making it. Okay. So, that's something that we really have to take into consideration. I mean, we're not too far from 50-50. Okay. So when we run into a scenario like this, you betcha that we're going to be looking at alternatives in order to come up with a scenario to where we can, better your chances. So step one in optimizing Social Security benefits. If Jane begins benefits based upon her earnings record in the estimated amount of $11.85 at age 67 per month, John begins, his benefits actually at age 70 now instead of a little bit earlier. We increased his benefit to $3,293 based upon what Social Security is providing. What we have to think about then is what are we using in other areas to help get there, right? When John begins drawing his benefits, Jane can add her spousal benefit, increasing her total again by a fairly substantial amount. Compare line 1 for Jane compared to line 3 for Jane, $11.85 to $16.46.50. In that example, that enhanced their position to a 73% probability of making it, with a 27% probability of not making it. And the third piece of this is optimizing the portfolio. So if we know that we're playing with the rules of Social Security between age 62 and age 70 and something in between, I am going to mention, we want to keep in mind age 70 is the max, right? At least right now. For anybody who's, going to retire, look at retirement or what have you, we chose age 70, be aware that's going to be our cap for now. Of course, those rules can change down the road, but I did want to mention that again. So if somebody had significant assets to where they said, well, I don't necessarily need to take it at my full retirement age at age 66 and so many months or age 67, maybe I'll wait to 68, 69, 70. That's a strategy to where, we can enhance that, but keep in mind 70 would be the cap. Age 70 would be the cap. So repositioning an existing portfolio of assets with the goal of maintaining returns while more importantly, reducing volatility. I like in this example, for most of us that are from the St. Louis area, you probably like baseball to some degree. If you recall during the 80s when Whitey Herzog was the coach, they ended up talking about Whitey ball. And so what we were talking about in Whitey ball is singles and doubles in order to win the game and not necessarily swinging for the fences for home runs. Yes, we had some of that, fortunately, for the Cardinals back then. But, the reality of the matter is that a lot of times it's everything that you're doing in the short to midterm that actually focuses on the long term and really helps that planning come together to where those singles and doubles are going to make a substantial difference as time goes by. So if you look at that and looking at the portfolio and how we work with Social Security, if we could increase that again from a 57% degree of probability of making it to a 92% degree of probability of making it, that's pretty good. That's a pretty substantial move. And that's the goal all along the way. The closer that we get to 100%, the better off we are. One of the things quite personally that I'll say to you is that when you walk into our office or we talk to you online and you're potentially working with us as a client, I'm going to tell you up front, I'm not going to get this right 100% of the time. If anybody ever tells you that, then you better turn around and walk away. We want honest conversations here to where, hey, we're going to do all we can. Maybe we get 98, maybe we get 99%. But, when we think about it, there are going to be times like right now when we look, is the market going to correct? Is it going to continue into a bull market? Are we going to land in a harder, softer recession? Those things that we have to really consider. I want to take another segue here real quick and talk about another real case, right? So we had a scenario to where a lady who retired as a nurse in her early 60s she came into us. We went through the planning, and one of the questions that came up in the second meeting was, I'm gonna probably take my Social Security now. She was at looking at full retirement age and saying, I should say that's what she was looking at. And she's like, I can live off some of my assets, right, to get to that, which is true. And we will look at that to maximize it. But the one thing that she did not remember in the entire conversation, which I brought up earlier in this presentation, is I said, you were married for a period of time, right? She goes, yes. I said, how long were you married? And I can't remember, but I know it was longer than 10 years. So if it had been 15 to 20 years, we have to think about that and say, okay, well, you know what? Not only can we look at your benefit, but we can also look at maybe your ex-husband's benefit and say, which one's going to be the best one for you? Again, sometimes people just do not think about that. Or if you're divorced, again, there's benefits there. We have to evaluate the best benefit for you at the time. Okay. So when we start looking at how those portfolios were optimized, I think most of you would rather be in that 92% segment than any of the alternative. So when we start talking about, the recap of what we're looking at today, Social Security benefits are very, very powerful for you. They can be utilized just like the chess pieces on a board to where and when, right? On a couple of the gamuts in chess, one of the worst things that you can do is bring out a knight or bishop too early. And the same can be said about Social Security. If you do not know how this is going to negatively impact you, and you're looking at drawing at age 62 or 63, I think we better have a deeper conversation. So item number 2 there, the many factors that come into play: marital status, health and longevity, retirement savings. I will tell you that there's been a number of times that we've sat down with people that were healthy as can be, and over a relatively short period of time, over several years, something came up. And when that health event came up, it could have been a diagnosis of maybe it was diabetes, and maybe it was a combination along with maybe cholesterol or something. When you start adding some of those things up that are going on in a person's life, we have to take that in serious consideration about, do we maybe take it earlier at this point? Can that person continue to work? There's lots of those things that we have to talk about. So it's really important that you consider all the factors before making the decisions, as it states in item 3. Our firm can help you with that. St. Charles Financial Services, between myself, Jerry, the team, there are many, many years of experience. We'd be excited to be able to help you through that. And as we talked about in the kits that we typically hand out to people, there's a lot of good information in that. I'm going to continue to reinforce that to where that's just the introductory piece. And then we have a 45-minute to an hour long introductory meeting in the event that you want to sit down on that. Okay, so when we start thinking about the key pieces, Social Security, retirement savings, and employer-sponsored plans, I'm going to reiterate something that I said earlier on in this presentation because I'm not sure if I hit on it enough. If you think about years and years ago, what was probably the main benefit for most families? Not just Social Security, it was also pensions. So for many, many years, if you were working for a company that had a pension and you filed for Social Security, that could be a big chunk of your overall retirement income. Well, what has happened over the recent past is that has shifted. More and more companies are using what they call, the 401ks and 403b plans, depending on who you work for. And, at the end of the day, that burden has been shifted more and more onto us, right? The consumer, the person looking at retirement, all those things that we we need to really take into consideration. So at the end of the day, I can tell you there's a lot more people that I talk to now that if they have pensions and they're older, they're smaller pensions. There are still some very good pensions out there, but we're seeing fewer and fewer of those larger pensions amongst people that we talk to, especially when we get into the various younger generations. And if there's anybody on here that's 20s, 30s, 40s, and you're thinking about parents or you're thinking about yourself, that's a pretty big deal. At the end of the day, if that person has a large pension and something happens to them, what happens to that pension benefit? What happens to that if it were to go to a spouse? Was it set up that way? We have to look at various things inside of that in order to make sure that we maximize what we're trying to do for you. Okay, next up, there's a QR code there, as you can see. We can end up setting up a no obligation appointment. I'll tell you, this is definitely a consultative educational approach, and we want to make sure that what's being done is right for you. This office, first and foremost, I want to treat you like I want to be taken care of. We have a mission statement on the wall for that, and I live by that. So we would be excited to move forward with the meeting with you. What you can expect from us, whether it be in office or online, we want a comfortable learning space. You want knowledgeable guidance. You want some expertise there. I will tell you what we are and what we are not. I'm not a CPA. I'm not an attorney. We have attorneys and CPAs that we refer people to. If you have one that you're working with that you're very comfortable with and you really like, first of all, I'd love to be able to talk to them and meet them because I'm always very receptive to other professionals that are doing a fantastic job in those two spaces when we're thinking about tax and the legal side. There are no hidden or unexpected fees. What you're going to end up finding is even if you look at our website, there is a 10-step process that we use. Steps number 4 and steps number 5 in that 10-step process. It's what I call the ground rules, what you can expect from us and what we want to and what we will expect from you. And I think you're going to like that piece a lot because when we describe this to you, we can work with you a number of ways, whether it's on a fee basis, whether it's on a commission basis. Those are the two main ways that people work with clients today. A lot of fee basis today, a percentage of assets under management, or we can combine those things. We are rather unique in that approach because we are offering both or a combination hybrid of those things. Okay. So ask yourself, basically, is 45 minutes in an introductory meeting worthwhile to potentially get started in this? Another thing that I'm going to put out there for you is once we do get started on this, we will maintain a 2-week time frame as much as we possibly can, unless it doesn't meet your time frame. We want to keep this material fresh to where over a series of a couple meetings or multiple meetings that we're done within short order to where you have an action plan to where we can implement it, and then we can continue to adjust it as the years go by with the reviews at hand. So I'd like the time to say thank you, and I appreciate you attending this today. We look forward to any responses, questions, or what have you right now. Nathan, if you wanted to go ahead and if there's anything out there, be happy to address it.
Yeah, so right now, Heather asks the question, does that also work for a deceased spouse? So when we're talking about going back and claiming Social Security from a spouse, does that work if the previous spouse was deceased?
So in the example, yes. So let's say that somebody had a spouse that passed away 10 years ago and they're age 60. They had been married for 15 to 20 years. Absolutely. We're going to look at the higher of yours, or we're going to look at what is yours or what is your deceased spouse according to the Social Security system. And we're going to end up making sure that we maximize that benefit for you.
All right. I have one other question here is what other strategies do you guys consider outside of the standard 401k pension plans and Social Securities? What other types of tools do you guys utilize is basically the question.
So in our firm and the way that we are licensed, and again, I encourage anybody who's on this, if you go to a website, finra.org, there's a thing called broker check. We actually have it on our website to where if you want to check me out, anybody out, you can go there and look at it. We are fully licensed to be able to talk about various products that fit inside of whether it be a 401k, an IRA, a Roth IRA, I'm going to tell you the very foundation of every financial pyramid is protection. Okay, it starts with protection, then it goes to what? Maybe it's a CD, something fixed, guaranteed. Then we go into stocks, bonds, mutual funds, and you keep going up the risk spectrum. Okay, and that foundation needs to be protection. So just like your home and your car is protected by a homeowner's or an automobile insurance policy, you may also have an umbrella liability insurance policy. We have to think about that for your life, for your long-term care, right? In the event that you live too long, okay, that'd be a good thing for a lot of us. But if you're incapacitated and you have to live off of your assets and you're depleting those assets as time goes by, because it's not inexpensive to have full-time around-the-clock care. That's another piece of what we talk about is, we have to look at that in depth and say, okay, how do we maximize those assets and income long-term while this situation is happening? Okay. It's very, very important to know what that looks like. I can use lots of examples, but I can tell you a lot of the dementia style illnesses. I've seen it. We had a representative with us one time years ago, worked with us for several years, that her mother and her father had a dementia style illness, each of them for 10 plus years. So if you need a lot of care, around the clock care, and you think about the dollars and cents today, and there's a wide range, and it's different in the Midwest compared to the East Coast or West Coast, that can be a fast way to deplete savings. So we have a lot of things available to us. Like I had mentioned, there's also alternative investments that we use, and we have to think outside the box with some of those. So in an environment, for example, to where if anybody knows about bonds, right? If we end up seeing interest rates climbing, that means the principal can drop if you get out of them early, right? A little bit of a concern. But if they're used properly, they can be very strong, and the portfolio is an anchor. Okay. So we have to think about what are those alternatives that in the event that we're in the wrong marketplace, like last year where equities and bonds both dropped in value. So, as I mentioned, 2022 was a rather rough year when you take a look at the traditional 60-40 portfolio.
Thanks, Mike. It looks like we got two more questions, and we'll try to keep this short for you guys because I know we're right at about an hour now. So I appreciate you hanging in there with us. The next question that I have here, this one looks like it comes from Dan. Dan says, I'll ask the question this way. Is there a minimum amount of assets that somebody needs to be able to move under management with St. Charles Financial Services? Or how do you work with just Main Street America? How does that work?
So I appreciate that, Dan, because that's something that I find in the industry that I do not applaud. There are firms that set minimum standards. You cannot talk to them or work with them if you have under $1 million or whatever the minimum is. No, we really take that off, because at the end of the day, we have clients right now that have children that are making income and trying to build a family and do all those things. Do they have $1 million? No. So what we want to do is we want to be able to work with everybody that we can. And the message is quite simple. Remember, I said liquidity, use, and control over your money with knowledge, access to capital, right? Having access to that income and having access to your assets. These principles have to be taught early. And that's why I'm encouraging our clients. There's something that we can do to where when we sit down with you and say, hey, you have 2 or 3 generations under you or above you, whoever we're talking to. There's a system that we can point people to where it's going to help them learn some of these principles even outside of our conversations. But we love it because it actually helps reinforce what we talk about, because at the end of the day, that's what it boils down to. You have to have access to money. We have to have cash flow. Those things are absolutely mandatory in order to live the way that we want to live our life.
All right. And Mike, I just have one last question, and this one's actually from me. And I just wanted to know, just for the viewers that are watching this on replay, if I was to refer my family member or friend to St. Charles Financial because I feel they need some help, what makes St. Charles Financial Services the place for me to send people that I know too? Why do we have so many referrals? What makes us uniquely different?
So I'm going to answer that a couple of ways. That's a loaded question, Nathan. I'm going to have to answer that a couple of ways. So we'll make it a little fun. We have to think about the team. It's not just me. It's not just somebody else sitting next to me. We have a team of people that are here to help. Okay, first and foremost. And when we talk about that team, there's areas of expertise that matter. Often enough, you can equate it to, again, playing chess, right? I mean, the king by itself cannot do much. The queen by itself can do quite a bit, right? That's probably the most exciting piece on the board. But then sometimes it's as low as the pawn who actually makes the right strategic move at the right time. Everybody on the team, and this is true for any organization if they're really running the right way, we have to focus on that client and the multiple clients that we're working on at the time. What's coming up in the next quarter? What's coming up in the next 6 months? Make sure that we're on task with that. That's part one. Part two is what really makes us unique. I'm going to point to that 10-step process again. Okay. We want to help you to find money that you're potentially transferring away, whether it's you know it or you don't, and put that money back into your pocket. So I'll use an example. If you go down to Quick Trip and spend $100, it's consumed and gone forever plus what? All the interest that money could ever make. I had a friend of mine talk to me about one time, and he goes, my daughter's going to be getting married, and she's talking about a destination wedding, and it was during the pandemic, actually. And then he came back and said, well, that destination wedding was like $65,000 or something. And he came back, and because it was the pandemic, they canceled the flights. They had it in his backyard. It was a comfortable environment for probably it was probably like 75% less. Okay. That's a wealth transfer. All right. You have to think about what's going on today. A wealth transfer such as, are you living for today? Are you living for tomorrow? Are you doing it the right way and living for both? That's the ideal situation. But if we can end up lining up, if we're meeting with a client, 7, 8, 9 areas of wealth transfers, even if it's 3 to 5, and let's say, for example, that we found 5 and it totaled $10,000 this year. Well, if we could even just make it an average of $5,000 a year as you're a client with us over the next 20 years at interest, that adds up to be quite a bit of money. Because it's not just the money that you lose, it's the money that you could have earned. In the economic term, it's called opportunity cost. And we really have to think about that in all areas of our lives. And so when we talk about our unique approach, we're not just looking at a portfolio to put an investment allocation together to get a rate of return. We're going to be looking at everything to stop those wealth transfers from happening as much as we possibly can, while at the same time strategically working in these areas over the years to help you and put you in a better position.
That's so true, Mike. I know we often say at our firm, what if everything you thought to be true about financing and finances ended up not being true? When would you like to know?
Oh, absolutely.
And that's what we have at St. Charles Financial Services, is a unique approach, a unique strategy that helps you move your chessboard, guys, helps you move the pieces on your chessboard to accomplish the financial goals that you have for yourself. So if you'd like, you can always visit stcharlesfinancial.com. That's stcharlesfinancial.com. You can reach out to us at 636-946-0001. That's 636-946-0001. And if you're watching this on replay again, I'd like to say thank you. Thank you for taking the time to make it all the way to the end, guys. Thank you for taking the time to be a part of our webinar series. And we'll be on the lookout through your email for the next webinars that we have coming up. If you like this kind of information, send us an email and let us know. I like the information, or this is the stuff I'd like to learn. Thanks for taking the time. Yeah, thanks, Mike. Thanks for being here.
Absolutely. And thank you. I would like to add a little twister to this, and I want people to think about this. So you finance everything you buy, whether you pay cash for it or you go to the bank to borrow against it. If you want the answer to that question, I think you need to come talk to us. Thank you.
Thank you. You guys have a good afternoon.